China is the bigger risk in trade war, not Trump. CEO President Donald Trump has made clear that he has no intention of backing down on trade tensions with China. Doubts over whether Beijing will be willing to compromise on a potential trade deal with the U.S. makes it a bigger risk than Washington, said Martin Gilbert, co-chief executive of Standard Life Aberdeen, on the sidelines of the Singapore summit. Beijing could be the wild card in trade negotiations with Washington, according to Europe's second-largest fund manager. The bigger risk of a trade war lies in the Chinese side rather than the U.S. side, said Martin Gilbert, co-chief executive of global investment firm Standard Life Aberdeen. President Donald Trump is used to making compromises in deal-making, Gilbert told CNBC's Nancy Halgrave on the sidelines of the Singapore summit over the weekend. But whether China will do that, I think, is the bigger risk, he continued. Trump has made clear that he has no intention of backing down on retaliatory tariffs that threaten to disrupt global supply chains, even as Washington and Beijing prepare to meet later this month to resolve their differences. The White House is reportedly planning a fresh round of duties on up to $200 billion of Chinese goods. If that takes place, Chinese President Xi Jinping's administration may not want to participate in bilateral talks, The Wall Street Journal announced on Sunday. Trump's negotiating tactics stem from his art of the deal philosophy, which is ask for $5 billion when you want $1 billion, Gilbert stated. I think he'll always settle for less than he is asking for, Gilbert continued, adding that he expected the two parties to eventually reach a compromise. Standard Life Aberdeen, which operates in China, was created following last year's merger between Standard Life and Aberdeen Asset Management. It reported $790 billion in assets under management and administration in the first 6 months of the year. When asked how his company stood in relation to China's asset players, Gilbert noted the latter group enjoyed a huge advantage over their foreign counterparts. China's very clever at getting you in, and probably making sure you don't make too much money, he said. Why President Trump will keep escalating the trade war with China until after the midterm elections. Trump needs to back off before the economy turns on him. When U.S. Treasury Secretary Steven Mnuchin extended an invitation to his Chinese counterparts for a new round of trade talks, it almost seemed as if the U.S. administration was taking proactive steps toward de-escalation of trade tensions. Then President Donald Trump tweeted that The Wall Street Journal has it wrong. We are under no pressure to make a deal with China, they are under pressure to make a deal with us. Similarly, sources close to the president said over the weekend that he should announce 10% tariffs on $200 billion of Chinese goods in the coming days. This follows his Friday statement that he is ready to issue tariffs on another $267 billion in Chinese goods if he wants. All told, tariffs imposed and threatened would cover all Chinese imports to the U.S., which amounted to $505 billion in 2017. Is this just another instance of Trump's pressure diplomacy, or should we brace for a full-fledged trade war? The answer lies somewhere in the middle. Where we stand, neither the blunt pressure tweets nor the contradicting of statements by his own cabinet members are new. Following Mnuchin's statement in May that the United States is not in a trade war with China, President Trump put an end to the temporary truce between the two trading blocs. Trump's tweet also follows a pattern regarding upcoming talks with foreign governments, the recent talks with the European Union being a case in point. Just days ahead of his breakthrough meeting with EU Commission President Juncker on July 25, Trump called the EU a foe of the United States. But even if Trump's statements and tweets are simply the continuation of a pattern that aims to portray the United States in a position of strength, they do have damaging repercussions. While China has welcomed Mnuchin's invitation to come to Washington, it remains questionable how much can be achieved. Not enough trust to do a deal. One of the biggest obstacles will be mounting trust and credibility issues between the two parties, exacerbated by Trump's downplaying of Mnuchin's invitation to China. This makes it unlikely that China will make any major concessions during potential talks for fear that any outcome would be overturned in whole or in part by President Trump afterward. Mnuchin's negotiating position is further weakened by internal disagreements within the administration on how to deal with China, while White House Chief Economic Advisor Larry Kudlow is in favor of keeping talks with China alive. U.S. Trade Representative Robert Lighthizer is opposed to resuming negotiations because he believes ramping up tariffs would increase U.S. leverage in future talks. If the two sides do want to move forward in a meaningful way, there would have to be reassurances from the U.S. side that any mandate for Mnuchin is backed by President Trump. Another option would be to keep Trump personally involved in the talks with China. A good opportunity for this is the G20 Leaders Summit in Buenos Aires at the end of November, that both Trump and China's Xi Jinping are scheduled to attend. Meetings like the one led by Mnuchin could lay the groundwork and technical details for any possible deal discussed by Trump and Xi. Regardless, the threatened tariffs on the $200 billion of Chinese goods look increasingly likely to happen, even though extensive public hearings on the tariffs show deep concern over their impact. If the administration were to announce additional tariffs over the next week, it raises the question in how far it has taken into account the thousands of comments made during the comment period and the public hearings that ended 10 days ago. While sources currently hint at a broad-brush approach of 10% on $200 billion of Chinese goods, there are several options for the implementation, ranging from different tariff rates for different sectors, as happened with steel, 25%, and aluminum, 10%, to gradual implementation, as with the tariffs on $50 billion on Chinese goods on the basis of China's discriminatory and unfair practices and policies related to technology transfer, intellectual property, and innovation. There is a very slight chance that ad hoc bilateral talks still happen before the tariffs are issued. There also is the very unlikely possibility of pausing the trade war, but keeping the threat of further tariffs on the table, as President Trump has done with potential car tariffs during his negotiations with Canada and Mexico. In the event that tariffs are announced, the extent of countermeasures taken by China could influence whether the U.S. administration withdraws its invitation to the talks altogether. Domestic politics could slow the tariffs. Given the growing concern over the tariffs from the U.S. business community, voters, and parts of his own party, it is less certain whether President Trump would implement the tariffs in full ahead of the U.S. midterm elections in November. In contrast to the last round of tariffs, the next round of tariffs as well as Chinese retaliation would impact the average American household, as everyday consumer goods, like paper, textiles, and more are affected by the list of products targeted. With a view to Thanksgiving, Black Friday, and Cyber Monday shopping in November, a combined online shopping spend of $14.5 billion in the U.S. in 2017, both of high value to the U.S. economy as well as to U.S. voters. A gradual implementation of any additional tariffs on China seem likely. China will be watching the midterm elections very closely, as a win for the Democrats would potentially weaken the president's hand domestically. Despite mounting political pressure to end the trade war, favorable economic conditions still put the United States in a strong position. President Trump tweeted that our markets are surging, alluding to record employment numbers, higher wages, and the U.S. economy surging at 4.1% in the second quarter. Yet experts caution that this soon will change, as the impact of additional tariffs would reverse economic tailwind created by the combination of more government spending and the hefty tax cuts. While voices are becoming louder that a fully fledged trade war with China could be part of a longer-term plan of the U.S. administration to decouple the two economies altogether, it is questionable how this would play out in reality. Given recent developments, the prospects for a quick resolution of the trade war are unlikely. Yet, we can expect the U.S. and China to continue talking, even as the implementation of next round of tariffs will be announced soon to exert further pressure on China. While Trump is in no rush to come to a quick solution, he will be gearing up to campaign for the 2020 presidential elections soon after the midterms. De-escalating the situation with China before current economic tailwinds are reversed would not only make economic sense but also put Trump in a strong position for re-election. Trade war risks ramp up for stocks as companies start curtailing investment. Earnings could take a hit with input costs rising faster than selling prices. The threat of an escalating trade war with major partners is the biggest risk facing U.S. stocks and could become a major drag on earnings in 2019, according to J.P. Morgan. Analysts use text mining tools to analyze more than 7,000 earnings reports, including the transcripts of earnings calls, to track commentary relating to trade tariffs, tax reform, input costs, shareholder returns, and investment spending, and found most companies are more focused on trade conflict and on the December tax revamp. Two-thirds of industrials companies and staples and more than half of materials companies mentioned trade risk on earnings calls, the analysts found. Within tech, there was a notable uptick from semis and tech hardware discussing trade/tariffs during second quarter earnings season, while software saw only a slight uptick from last year, they wrote in a report. U.S. investors don't seem too concerned about the potential impact on third quarter results yet, as the S&P 500 index SPX plus 0.03%. Has rallied 6.7% since the end of June, while the SPDR Industrial Select Sector Exchange traded FUNDXLI plus 0.50%. Has run up 10.0%, the SPDR Consumer Staples ETF XLP minus 0.27% has gained 6.1%, the SPDR Materials ETF XLB minus 0.03% has tacked on 2.4%, and the SPDR Technology ETF XLK minus 0.08% has advanced 7.7%. J.P. Morgan estimates that the initial round of tariffs China and the U.S. have imposed tariffs on $50 billion of imports from each other have so far had only a roughly $1 impact on 2018 per share earnings in aggregate, out of roughly $30 EPS growth expected for the year. Commentary generally reflected that, the analysts said in a report. Read more in MarketWatch's Trade War Tracker. Companies have options to mitigate the trade headwinds, including passing rising costs on to end users, altering their supply chain and production, and seeking trade exemptions, they wrote. However, the full-year EPS headwind could increase to $8 to $10 under a more restrictive/severe trade scenario, which would result in significant negative revision to forward EPS estimates, said the report. The Federal Reserve's Beige Book, which collects anecdotal information from businesses across the country, released Wednesday corroborated the report and could portend a trade-related headwind to third-quarter results. The prior Beige Book through July 9 noted that manufacturers in all 12 Fed districts expressed concern about the impact of tariffs, with many reporting higher prices and supply disruptions as a result of new trade policies. The latest Beige Book, covered the 8-week period through August 31, indicated that some businesses started to act on these concerns. A number of districts noted that such concerns had prompted some businesses to scale back or postpone capital investment, the Fed's report stated. The latest book also indicated that all districts reported fairly widespread input price increases, with tariffs contributing to the higher costs. As a result, input costs for businesses have generally been rising more rapidly than selling prices, which could put pressure on gross margins and earnings for the third quarter. Investors may be in for a bit of a surprise, as Wall Street analysts have so far not priced in much, if any, of the potential trade-related weakness. During the first 2 months of the third quarter, the bottom-up consensus earnings estimate for the S&P 500 companies slipped 0.9% to $40.63 a share, from $41 a share, according to a report by FactSet senior earnings analyst John Butters. But that was a much smaller decline, and the average 2.5% drop during the first 2 months of a quarter over the past 5 years, and the average 3.6% decline over the past 10 years. A third of U.S. companies in China may put off investments over trade worries. Half anticipate loss of profits due to tariffs. Beijing. A new survey of U.S. companies doing business in China found that 31.1% are considering delaying or canceling investment decisions over uncertainties created by tariffs and U.S.-China trade friction. In addition, 50.8% of the companies surveyed said they anticipate a loss of profits because of the tariffs, while 47.1% said they are bracing for higher manufacturing costs. American companies are suffering both from China's retaliatory tariffs and, ironically, from U.S. tariffs designed to harm the Chinese economy, the American Chamber of Commerce in China and the Chamber's Shanghai chapter said in a joint statement. The survey is based on responses from 432 of the two chambers' member companies and was conducted between August 29 and September 5, they said. The chambers didn't release the names of respondents, but members of the chambers include China-based operations of Apple Inc. KAPL, minus 1.14%, Boeing Co. BA, plus 1.22%, and General Motors Co. GM, plus 1.11%. As Trump's trade war mounts, China's Wall Street allies lose clout. Hong Kong. When President Bill Clinton deliberated whether he should loosen trade barriers against China, Wall Street helped plead Beijing's case. When Presidents George W. Bush and Barack Obama talked tough about labeling China as a currency manipulator, Wall Street urged restraint, and both presidents backed down. Today, China is hoping that Wall Street will once again use its political heft to soothe tempers in Washington. But as President Trump ratchets up the trade war with Beijing, Wall Street's words are falling on deaf ears. Senior Wall Street executives met in Beijing on Sunday, with current and former Chinese officials and bankers at a hastily organized session to find ways to strengthen financial ties between the United States and China. On Monday, the group, which included executives from Goldman Sachs Group, Morgan Stanley, and the Blackstone Group, the private equity firm, among others, planned to meet with Vice President Wang Quanhan, the right-hand man of Xi Jinping, the country's leader. New trade talks between the two governments are tentatively scheduled between Steven Mnuchin, the Treasury Secretary, and Liu He, a Chinese vice premier, later this month in Washington. Stephen A. Schwarzman, Blackstone's chief, has been playing a critical role in organizing them, say people familiar with the talks, who asked for anonymity because the process is sensitive. But the Chinese have indicated that they will pull out of the talks if Mr. Trump follows through on his threat to impose tariffs on another $200 billion in Chinese goods, according to a person familiar with the matter. Mr. Trump has told advisors that he wants to move ahead with the new round of tariffs, and an announcement could come as early as this week, another person familiar with the discussions said. That continues a frustrating trend for America's financial titans, even as they win tax cuts and regulatory rollbacks from the Trump administration and the Republican-controlled Congress. They appear to be able to do little to stop the trade war. What's really surprising is that the connections that used to work, the formula that used to work, just don't work at this point, said Marshall W. Meyer, an emeritus professor of management at the Wharton School of Business. Wall Street has long gambled that helping China would pay off. China has been slow to open its vast but tightly controlled financial markets, and Wall Street banks hope to get more business advising Chinese companies on acquisitions in the United States, lending money, and selling financial services. Pressure from the Trump administration is now bearing fruit as China has begun to open its financial markets to foreign banks, though a worsening trade war could stymie that progress. The financial sector's arguments have often found a sympathetic ear in Washington. Over the past 2 decades, China has emerged as a major global economic growth driver and as an important customer for many American companies, including Apple, Qualcomm, and General Motors. But the Trump administration's trade hawks have so far prevailed against Wall Street-friendly voices of trade moderation, such as Mr. Mnuchin, a one-time Goldman Sachs executive. That is partly because the trade war hasn't shown President Trump much downside. His stance has won support from both parties. The United States economy shows few signs of trade war damage, and markets continue to rise. Even if Republicans lose Congress in November's elections, the trade war will probably continue, said Robert B. Zoellick, a former United States trade representative. Only a slump in the markets might make him reconsider. Mr. Zoellick said. I don't think that's going to affect Trump, Mr. Zoellick said about November's elections. Markets could. Relations between President Trump and Wall Street are complicated. Last year's tax bill greatly favored big financial companies, but some financial executives have clashed openly with Mr. Trump. Morgan's chief executive, Jamie Dimon, a one-time informal advisor to Mr. Trump, said last Wednesday, in a speech, that I am smarter than he is, and that unlike Mr. Trump's, his personal wealth wasn't a gift from daddy. Mr. Trump the next day called Mr. Dimon a nervous mess, and Mr. Dimon has since said he shouldn't have made the remarks. Others, like Morgan Stanley's chief, James Gorman, and the chief executive of Goldman Sachs, Lloyd C. Blankfein, oppose Trump policies, like his original travel and immigration ban. In the past, Wall Street was an effective advocate. In the late 1990s, when China's effort to lower trade barriers faced tough political opposition, China flew its premier, Zhu Rongji, to New York to meet directly with financial and business leaders. Senior leaders of Goldman Sachs and the American International Group, the big financial conglomerate, urged President Clinton to strike a deal. He did, and China joined the World Trade Organization in 2001. Wall Street also discouraged the United States from formally accusing China of manipulating its currency. Both President Bush and President Obama vowed to get tough on China's long-standing efforts to weaken the value of its currency to help its importers. Wall Street banks urged them to reconsider. Both ultimately backed down. President Trump has also threatened to label China a currency manipulator, though the currency has strengthened considerably in recent years. Business leaders and some members of his administration have discouraged him from acting. The Wall Street influencer and Robert E. Rubin, a Wall Street veteran, served as Treasury Secretary under President Clinton and helped forge the consensus within the Clinton administration on how to bring China into the World Trade Organization. Henry M. Paulson, Jr., a former Goldman Sachs executive with a high profile in China, served as President Bush's Treasury Secretary. Wall Street figures have cultivated China connections in other ways. Mr. Schwartzman has raised more than $500 million to build a scholarship program in his name at China's prestigious Tsinghua University. Goldman Sachs last year said it would help China's sovereign wealth fund put $5 billion into acquiring stakes in American businesses. Mr. Schwartzman is working behind the scenes to get China and the United States talking again. He urged American officials to invite their Chinese counterparts to resume talks, according to the people familiar with the discussions. Last week, Mr. Mnuchin issued an invitation, which Chinese officials publicly greeted warmly. But Larry Kudlow, President Trump's chief economic advisor, and another Wall Street veteran, suggested afterward that China had sought the invitation. There are some discussions and information that we've received that the top of the Chinese government wishes to pursue talks, he told Fox News.